Have you ever moved money from one account to another, deposited a large amount of cash, or helped a family member financially without thinking twice about it? Most people do these things every day because it is their money, and they assume there is nothing unusual about using it. After all, if the funds were earned legally and belong to you, why should anyone be concerned about where they go? What many people do not realize is that modern financial systems are designed to monitor specific transaction patterns. Banks are required to report certain activities, and sophisticated software continuously analyzes transactions for signs that may require additional review. In many cases, completely legitimate financial moves can attract attention simply because they resemble activities that regulators are trained to monitor. That does not mean you should be afraid of using your money. It simply means that understanding the rules can help you avoid unnecessary complications. Knowing how certain transactions are viewed by financial institutions and tax authorities allows you to handle them properly and maintain clear documentation if questions ever arise. One of the most common situations involves large cash deposits. Imagine that you sell a fishing boat, a recreational vehicle, or a used car and receive $12,000 in cash from the buyer. Before going to the bank, you remember hearing that deposits above $10,000 require additional reporting. Wanting to avoid extra paperwork, you decide to split the money into two separate deposits of $6,000 each on different days. At first glance, this may seem like a harmless decision. However, financial institutions often view this type of activity differently. Deliberately breaking up cash deposits to remain below a reporting threshold is known as structuring. Even when the money is completely legitimate, the transaction pattern can appear suspicious because it resembles behavior associated with attempts to avoid reporting requirements. Modern banking software is specifically designed to identify these patterns. Multiple deposits made within a short period of time can be linked together automatically, and the account may be flagged for additional review. In many situations, the issue is not the source of the money, but rather the appearance that someone is attempting to avoid standard reporting procedures. For that reason, depositing the entire $12,000 at once is often the simplest and safest approach. The bank will complete a currency transaction report as required. This process is routine and occurs every day at financial institutions across the country. Completing the report does not automatically create a tax issue, nor does it imply wrongdoing. It simply documents the transaction according to federal requirements. When funds are legitimate and their source can be explained, transparency is usually the most effective approach. Another situation that frequently catches people by surprise involves financial gifts to family members. Consider a scenario in which your granddaughter is purchasing her first home and needs help with the down payment. You decide to transfer $25,000 directly into her account because you want to support her future and help her achieve an important milestone. Most people view this as a simple family matter, rather than a tax issue. However, federal gift tax rules apply even when money is transferred between close relatives. For the year 2026, the annual gift tax exclusion is $19,000 per recipient. This means an individual can generally give another person up to $19,000 during the year without triggering additional reporting requirements. When a gift exceeds that amount, additional documentation may be necessary. Many individuals assume that exceeding the exclusion automatically means they owe taxes, but that is not always the case. In many situations, the requirement is simply to file Form 709 to report the transfer. Filing the form does not necessarily result in a tax bill. Instead, it serves as a record of the gift for federal tax purposes. In addition, the 2026 lifetime exemption is $15 million. As a result, many people who exceed the annual exclusion still do not owe federal gift tax. Married couples may also use gift splitting, allowing them to combine their annual exclusions. Under those rules, a married couple can give up to $38,000 to the same recipient while following the guidelines described in this example. Understanding the reporting requirements before making a large transfer can help prevent confusion and ensure that generosity does not create unexpected paperwork issues later. Retirement accounts can create another area of concern, particularly when individuals decide to move funds between financial institutions. Imagine that you want to transfer your traditional IRA to a different broker. You request a distribution, receive a check payable to yourself, and deposit it into your personal checking account while you organize the transfer. Many people assume there is no problem because the money is still intended for retirement purposes. However, once you take possession of those funds, a strict timeline begins. The IRS generally allows exactly 60 days for the money to be deposited into another qualified retirement account. Missing that deadline can have significant consequences. If the funds are not redeposited within the allowed period, the entire amount may be treated as a taxable distribution. For individuals under age 59 and a half, an additional 10% early withdrawal penalty may also apply. What makes this rule particularly important is that even a short delay can create substantial tax consequences. Because of these risks, many people prefer a direct rollover instead. With a direct rollover, the money moves directly from one financial institution to another without ever passing through a personal checking account. This eliminates concerns about the 60-day deadline and reduces the possibility of administrative errors that could result in unnecessary taxes or penalties. Digital payment platforms have introduced another area where confusion can occur. Many individuals earn extra income by selling items online, providing freelance services, consulting, tutoring, or operating small side businesses. Payments may arrive through popular apps, making transactions quick and convenient. Problems often arise when personal and business transactions become mixed together. A single account might receive payments from customers, reimbursements from friends, family gifts, and shared expense repayments. Over time, distinguishing between taxable income and personal transfers can become increasingly difficult. For the 2026 tax year, the IRS reporting threshold associated with receiving a Form 1099-K from payment apps is generally $20,000 and 200 transactions. While many individuals may never reach those levels, reporting requirements can still become confusing depending on how payments are processed. In certain situations involving traditional credit card or debit card transactions, reporting may occur under different rules. The challenge appears when financial records become unclear. If personal reimbursements and business revenue are deposited into the same account, separating them later may require significant effort. Maintaining separate accounts for personal and business transactions often provides a cleaner record and simplifies tax preparation. Clear documentation can make a substantial difference if questions arise in the future. Foreign bank accounts create another reporting requirement that many people overlook. Retirees and seasonal travelers often purchase property abroad or spend extended periods in another country. To simplify daily expenses, they may open a local checking account to pay utility bills, maintenance fees, or property-related costs. Because these accounts are frequently used only for convenience, owners sometimes assume they are insignificant from a reporting standpoint. However, federal reporting requirements may still apply. One of the most important rules involves the $10,000 aggregate balance threshold. If the combined value of all foreign financial accounts reaches $10,000 at any point during the calendar year, the account holder may be required to file an FBAR, which stands for Foreign Bank and Financial Accounts Report. A common misunderstanding is that only wealthy individuals with substantial overseas investments must comply with these rules. In reality, even modest accounts used solely for routine expenses may fall under the reporting requirements if the threshold is reached. The requirement is based on account balances rather than account purpose. Even if an account earns no interest and exists only to pay bills, reporting obligations may still apply. Monitoring the highest balance reached during the year can help ensure compliance and reduce the risk of overlooking important filing requirements. Another area that deserves attention involves required minimum distributions. Once individuals reach age 73, they become subject to rules governing required minimum distributions, commonly referred to as RMDs. These rules require certain retirement account holders to withdraw a specified amount from their traditional IRA each year. Missing an RMD can create significant consequences. Imagine reaching the end of December while focused on family events, travel plans, or holiday preparations. In the middle of a busy schedule, it can be easy to forget a required withdrawal. However, failing to take the correct amount before the December 31st deadline can trigger penalties. The IRS closely monitors these requirements because retirement contributions often received favorable tax treatment when they were originally made. When the required withdrawal is missed, the government may impose a 25% excise tax penalty on the amount that should have been withdrawn. This can result in a surprisingly costly mistake. Many financial institutions offer automated solutions designed to reduce this risk. Scheduled withdrawals can help ensure that required distributions occur on time and that appropriate records are maintained. Automating the process can remove uncertainty and reduce the likelihood of missing an important deadline. Finally, there is the issue of mixing business income with personal finances. Many retirees and part-time workers earn supplemental income through consulting, tutoring, woodworking, crafts, or other activities. When payments arrive, it is often tempting to deposit everything into the same checking account used for household expenses, pension payments, and other personal transactions. Although convenient, this practice can create complications if financial records are ever reviewed. When business and personal funds are combined, distinguishing one from the other becomes more difficult. If questions arise regarding business income, a review of the account may require examining numerous unrelated personal transactions as well. Financial professionals often refer to this as commingling funds. Maintaining a dedicated account for business activity can simplify record keeping and create a clearer financial separation. Business income enters one account, business expenses leave that account, and personal finances remain independent. This structure not only improves organization, but can also make future documentation requests significantly easier to manage. The common theme running through all of these situations is the importance of transparency, organization, and accurate record keeping. Most banking activities are perfectly legitimate, and most people never encounter serious problems. However, understanding how certain transactions are viewed by financial institutions and tax authorities can help prevent misunderstandings before they occur. Whether dealing with cash deposits, family gifts, retirement accounts, payment apps, foreign accounts, required distributions, or side business income, maintaining clear records and following established procedures can go a long way toward avoiding unnecessary complications. A little preparation today can often prevent a great deal of confusion tomorrow. While many of these situations involve reporting requirements, it is important to understand that being reported and being audited are not the same thing. A common misconception is that whenever a bank files a report or a financial institution sends information to the government, an audit automatically follows. In reality, millions of reports are generated every year as part of routine compliance procedures. Most never result in additional action. The purpose of these systems is to identify unusual patterns and ensure that financial activities are properly documented. This is why maintaining records is one of the most valuable habits any account holder can develop. Documentation creates a clear timeline of events and provides evidence that transactions were legitimate. When funds are transferred between accounts, gifted to family members, deposited after the sale of property, or moved for retirement planning purposes, supporting records can help explain the transaction quickly and accurately if questions ever arise. For example, suppose an individual sells a recreational vehicle and receives a large cash payment. Keeping a copy of the bill of sale, the transfer documents, and any correspondence with the buyer creates a complete record of the transaction. If a large deposit later appears in bank records, there is a straightforward explanation supported by documentation. The same principle applies when selling vehicles, boats, collectibles, antiques, or other valuable personal property. Family transfers benefit from similar record-keeping practices. When substantial gifts are made to children, grandchildren, or other relatives, maintaining records of the transfer can help establish the purpose and nature of the payment. This becomes particularly important when gifts exceed reporting thresholds and forms, such as Form 709, are required. Clear records help ensure that the transfer is properly characterized and reduce the possibility of misunderstandings in the future. Retirement accounts deserve special attention because mistakes involving these accounts can be especially costly. Many people spend decades building retirement savings and understandably want to protect those funds. Yet simple administrative errors sometimes create problems that have nothing to do with investment performance. Consider how easily a rollover deadline can be missed. An individual may request a distribution with every intention of completing the transfer within the required 60-day period. Then, unexpected events occur. Travel plans change, family obligations arise, important documents become misplaced. Weeks pass more quickly than expected. Before long, the deadline approaches, and what originally seemed like a routine transfer becomes a potential tax issue. Situations like this highlight the value of planning ahead. Whenever retirement funds are involved, understanding the applicable rules before initiating a transaction can help prevent unnecessary stress later. Taking a few minutes to verify requirements often provides significantly greater protection than attempting to resolve a mistake after it occurs. The same principle applies to digital payment platforms. Technology has made financial transactions faster than ever before, but convenience can sometimes create new challenges. People frequently use the same payment application for personal reimbursements, business revenue, family transactions, and casual transactions with friends. Over time, hundreds of payments can accumulate within a single account. When tax season arrives, reviewing those transactions may become more difficult than expected. Identifying which payments represent business income and which represent personal transfers can require considerable effort if records were not maintained throughout the year. A small amount of organization on the front end often saves many hours later. Foreign financial accounts represent another area where awareness is extremely important. Many account holders are surprised to learn that reporting obligations can apply even when an account is used only occasionally. Because these accounts are frequently maintained outside an individual's primary financial routine, they can easily be forgotten when preparing annual tax documents. Someone might open a foreign account to manage a vacation property, pay local utility bills, or handle seasonal expenses. Months later, the account receives little attention because it serves a limited purpose. However, reporting requirements do not disappear simply because an account is inactive or used infrequently. Monitoring balances and maintaining accurate records throughout the year can help ensure that important obligations are not overlooked. Required minimum distributions create another example of how timing plays a crucial role in financial compliance. Many individuals focus heavily on growing retirement assets throughout their working years. Once retirement begins, attention often shifts toward preserving savings and managing withdrawals carefully. Because of this transition, some account holders underestimate the importance of annual distribution requirements. Missing a required withdrawal is often not the result of intentional non-compliance. More commonly, it occurs because life becomes busy. Financial responsibilities compete with family commitments, travel schedules, healthcare appointments, and countless other priorities. Unfortunately, the consequences of forgetting an RMD can still be significant regardless of the reason. This is why many retirement specialists encourage account holders to establish systems that reduce reliance on memory alone. Structured planning, recurring reminders, and automated processes can all help ensure that important deadlines are met consistently. Business income creates similar challenges when financial records are not properly organized. Small side businesses frequently begin as informal activities. Someone sells handcrafted products, performs occasional consulting work, tutors students, or earns income through a hobby that gradually becomes profitable. At first, depositing earnings into a personal account may seem perfectly reasonable. As activity increases, however, financial records often become more complicated. Business deposits mix with pension payments, personal transfers, household expenses, and routine banking activity. Separating those transactions later can become increasingly difficult. Maintaining dedicated accounts for different financial purposes provides a clearer picture of overall activity. It also simplifies bookkeeping, improves organization, and helps ensure that income and expenses can be identified accurately. These benefits extend beyond tax reporting and often make general financial management easier as well. Ultimately, the goal is not to avoid legitimate reporting systems or financial regulations. Rather, the objective is to understand how they work and ensure that transactions are handled appropriately. Most financial reporting requirements were designed to create transparency and provide information that regulators consider important. Knowing when those requirements apply allows individuals to navigate the financial system more confidently. The overwhelming majority of people who encounter reporting requirements have done nothing wrong. They are simply conducting normal financial activities, such as helping family members, managing retirement accounts, operating small businesses, purchasing property, or moving money between accounts. Problems typically arise not because the activity itself is improper, but because documentation is incomplete, deadlines are missed, or reporting obligations are misunderstood. By remaining organized, maintaining accurate records, and understanding the rules associated with major financial transactions, individuals place themselves in a much stronger position. Financial systems continue to evolve, technology continues to advance, and reporting requirements may change over time. However, the fundamental principles remain remarkably consistent. Keep good records, understand applicable requirements, and ensure that significant transactions can be explained clearly if necessary. When those principles are followed, managing personal finances becomes far less stressful. Instead of worrying about whether a transaction might create problems in the future, individuals can focus on making informed financial decisions with confidence and peace of mind.